Good morning and welcome everyone back to Charlie Mike and everything you needed to know about surety bonds. We have our friend Adam here from Parrot Surety Services, and he's going to talk to us about episode number 2. And Adam, that is looking at your screen, navigating the surety bond application process. That sounds so complicated. I'm hoping it's not, but you're the guy who's going to be able to tell us all about that. And so I am going to go into stealth mode again, and I'm going to turn it over to you.
All right, thanks, Marie. My name is Adam Milliren. I'm the owner and a surety bond specialist at Parrot Surety Services. So this episode that we're going to be diving into today. So last time we talked about all the different kinds of surety bonds and what they are. Today we're going to be talking about, hey, you're told you need a surety bond. What's next? We're going to dive into the application and the documents required for a traditional surety submission. So yeah, let's get started. The bonding process, just a quick overview. So as I said, you're told you need a bond. That's usually when you're going to go shopping for a surety bond, is when you're told you need one. Generally, you don't need one unless someone is requiring it of you. And in that case, the first thing you're going to need to do is find a surety agent. Your agent is then going to work with you to prepare your application, get all those bonding documents together, which this is where we're going to be spending most of the time today in this PowerPoint, is preparing that application and documents for submission to the underwriter, at which time the underwriter will take 1 to 2, maybe even 3 days to get back to you, ask some questions, or hopefully provide you with a quote. If all is good, the quote is accurate as your agent deems and you're happy with it, then there's just a few more things that need to happen. Execute the indemnity agreement, pay for the bond, and then receive your bond. So you established that you need a bond. Your next step here is finding a surety agent. Look no further, we're here. Yeah, but some other options that you have, we're members of the NASBP. A good way to find a good reputable surety agent in your area is the NASBP website. They have a Surety Pro locator where you can find someone local to you, or if you're a veteran business in the construction world, you might reach out to me and find Parrot Surety Services on there. Another alternative is the SBA Surety Bond Agency Directory. If you go to the SBA.gov, or just Google SBA Surety Bond Directory, you'll be able to find those agents. And lastly, as I mentioned previously, just come to our website. We are happy to help, especially in situations where people are struggling to get bonding or get a particular bond. We are particularly strong in those situations. So your next thing, once you have your agent, you're ready to go. The next thing that you and your agent, you're going to have a meeting. They're going to talk you through your application and documents, hopefully. They're going to tell you what to expect. But there are a lot of documents and a lot of questions on the application, so let's get into it. A little overview of the application, what's going to be required on there. They're going to ask company and ownership information. They're going to ask a few questions about your bonding history, legal history, bankruptcy, stuff like that. They're going to gather some information on your largest completed projects. They're going to want banking information, maybe credit line information. And then at the end of the application, there will be some sort of credit release authorization and potentially a general indemnity agreement that you're going to be signing. And then the documents that go with the application, financial statements, including 3 years of corporate financial statements and personal financial statements for all owners. If there's any, large cash positions or stuff like that, your agent might also ask for some cash verification, which is just like a screenshot of your account with a date, the total. Sometimes they may want 1, 2, or 3 from the past few months. But that's on a case-by-case basis. And then if you're on the contract side, they're also going to want a work on hand or WIP. And anything on here that's italicized is a maybe. So bank letters, resumes, and for owners and key employees might help bolster, if you're trying to stretch for a bond that might be outside your capacity or way larger than previous jobs, is when resumes would come in. And a bank letter can help can show, if you get your banker to write you a letter, it can show your average balances and your relationship with a creditor or slash lender. So the surety application, we're going to talk about each of those. I took these screenshots right from our electronic application online. So this is the company information that they're going to be wanting. The name of your company, legal structure, year you were founded, FEIN. A lot of this information goes on the indemnity agreement and allows them to pull credit reports. The business address, what type of work, what scope of work you do most. This is kind of like a quick summary of your business plan. Hey, this is the work we do. This is the percent that we do public. This is the percent that we do private. These are the trades that we normally subcontract, and typically about 40% of our work is subcontract. That kind of information is what they're looking for here. And then ownership information, including the owner's name, how much they own, social security number, and that same information for spouses. They ask about assets held in trust and any other ventures you may own. These are questions leading to perfecting indemnity for the surety. Usually they also ask nowadays for your email as a part of this to make sure that they have the email for all the indemnitors. So this stuff can be executed electronically. DocuSign. So the actual application questions, they ask about your bonding in your past. If you answer that you have been bonded in the past, they'll want to know who your prior surety was and what's your reason for leaving. They want to know if there's like bad blood in the water or if there was a claim situation. Leading on to the next question, have you ever failed to complete a project or had a claim? Have the company or owners declared bankruptcy, or are they currently the defendant in a lawsuit, convicted of a felony? And then lastly, have the company or any owners had state or federal tax liens or judgments in the past 3 years? So these are pretty run-of-the-mill questions on most applications. If there's questions missing from the application that a particular surety wants to know, that'll be a question that comes back prior to the quote. They might ask a few follow-up questions depending on where you got your application. This is the agency application, so it might be missing some stuff that some of the sureties actually want to know. Largest completed project. So this is super, super important that you provide your largest completed projects, because if you're going for more projects that are larger than what you've done in the past, it's important that you have projects within that same range of what you're going for. So this just provides some background information and contact information about that project, including, what the contract amount was and what your profit was. And we need to provide at least 3 of those to show depth there. So banking information, pretty straightforward. On the contractor side, line of credits are huge because working capital is always tight in the contracting world, especially for subcontractors with pay when paid clauses and stuff like that. Yeah. They want to know your bank contact name. They might contact them to make sure that you're in good standing, you're doing all the right things. They might try to get a bank letter from them depending on, your financial wherewithal and that kind of thing. So at the end of the application, there's going to be a credit release authorization. Ours does not have an indemnity agreement because we're an agency, not a market carrier, but pretty straightforward. Hey, everything that I said is true, and we're going to allow you to check our business and credit reports and check into all this stuff that we said, is essentially what the credit release will say. But if the indemnity agreement is included, make sure you know that you're signing the indemnity agreement and make sure you understand what it says, which we'll cover later. Personal financial statements. So the purpose of this, all owners need to provide them, but really it just presents your net worth and a breakdown of what goes into that net worth. It shows your assets and the correlating liabilities, and the underwriters make adjustments because they're not going to come after your life insurance. They're not going to come after your homestead. And so those things are usually rolled out. And really, they're just looking for, depth of wealth behind the company. If the company runs into problems, runs out of money, is there someone there to put money in? So either way, even if you don't have a ton of money, you're not independently wealthy, they still want to see, what your presentation is, and have that in their file. Next, we have the corporate financial statements. I cannot tell you enough how important it is to get a good CPA. And what I mean by good CPA is a good CPA for your business. If you're in the contracting world, you need a government contracting accountant. If you're in the construction world, you need that government contracting accountant or a construction accountant. Tax CPAs do not. I can't tell you how many times I get tax CPA prepared statements that just do not make sense. So make sure you're spending money on a good CPA if you're, getting up to that $1 million project size and looking to go over it. So the few different types of financial statements: balance sheet, income statement, statement of cash flow. The two mostly that we need and look at are the balance sheet and income statement. The balance sheet is important because it gives a snapshot of the wealth of your company, the equity there, your assets, liabilities. It lists those out, and the underwriters make some, adjustments to what they see there based on the line items. They could be positive or negative. The income statement shows essentially your net income or loss for a period, and that correlates to the balance sheet. Hopefully, those two things are talking to each other, and that's usually where the problems are with financial statements. So there's a few levels of financial preparation that can happen. Perhaps you do not have a CPA or bookkeeper, and you prepare your financial statements in-house. They're prepared internally by company staff. This doesn't offer a lot of assurance to the surety, but if they're clean, the balance sheet and income statements match, they can be just as good as a CPA compilation, which is compiled by a CPA who doesn't really, look into it too much, audit it or review it. Hopefully that CPA is also kind of doing some bookkeeping type of stuff to increase that level of assurance for the surety and the credibility of the financial statements that comes along with increasing levels. So a CPA review, the CPA compiles those, but they also look into them. If there's some like numbers that look off or stuff that they might see that doesn't make sense, they might try to adjust those and get those in the right order. But this offers greater assurance than a compilation or in-house prepared statement and can get you higher levels of bonding. So in-house and CPA compilations can get you 1 million, 2 million. If they're really good and balanced and you have a few years of them that are looking good, positive, profitable, you can definitely get up to 3 million. But if you're starting to get up towards that 3 million, I would definitely be doing a CPA review for sure. And if it's 2024, like it is right now, and in 2025, you're going to break that $3 million threshold of contract size, just go ahead and get a CPA audit done. This is a comprehensive examination by a CPA. These can take like 60 days and cost a lot more money, but in order to really get up over that $3 million threshold for small and emerging contractors for single project size, you're going to be looking at CPA audits for that. And so each level of financial preparation brings increasing levels of insurance and credibility to the financial statements for the surety writers, and this helps them assess the risk and your financial stability and how much they can rely on those financial statements as they stand. The last document for contractors in the construction world, work on hand schedule. So this is just all your current projects that you have, when they started, when they're completed. It shows the contract price, how much you've billed, and your total cost to date, and the remaining cost of the contract. So this just shows profitability and whether you're underbilling or overbilling. And this is where underwriters really look into. This is mostly, I would say, for underwriters, something for larger contractors who have multiple projects. This just makes sure that they're not overbilling and borrowing money from one job for another job, which can be a sign that a contractor is not cash flowing that well. So the next step, once you and your agent have all those documents together, your surety agent will go ahead and submit your application and documents to the appropriate surety markets, 1, 2, 3 of them maybe, and get some quotes back, I hope. So this can take 24 hours, 48 hours. They may come back with questions. They may come back with a quote. But we're going to dive deep into this step on our next episode, where we're going to talk about financial statements and what exactly underwriters are looking at, the ratios that they're looking at, and give you some tips to help expand that capacity in episode 4. So hopefully they come back with a quote and you have that approval. And once your agent has that approval and that quote, it's pretty much that's it. There will be a few more things you need to do. You might have to sign that indemnity agreement if you hadn't already. Pay the premium for the bond, and then that bond will be issued. So whenever you go to sign the indemnity agreement, disclaimer here, I'm not a lawyer and this is not legal advice, but there's definitely some stuff that you need to know. First off, everybody that's expected to sign the indemnity agreement, owners, their spouses, any trusts that you have, associated companies, all expected to sign the GIA. Individual cases, you can talk to your agent about them and they can definitely help. But the GI is a contractual agreement between the contractor or the principal and the surety company. It ensures that the contractor will reimburse the surety for any losses incurred due to the contractor's default. So this is not insurance. This is just insurance for the obligee, not for the principal. Remember that. There's joint and several liability, which means all of the indemnitors aren't necessarily equally liable for any kind of claim situations. It could be one person. If there's only one person with money and that's the only person with the money, they might be the person who has to pay up. So joint and several liability. And the way that I like to talk about the indemnity agreement with contractors is that how the surety sees it. They want to see that the contractor has skin in the game commitment with the surety. They want to know that if something goes wrong on the project, you're not going to bail out, and that you're all in on this. You're dedicated to the mission at hand, getting that contract delivered to the obligee and that project. If you don't want to sign, or there's somebody who doesn't want to sign, it's definitely possible, depending on who it is and that kind of thing. But definitely expect higher rates and potentially collateral requirements to make sure that the surety is covered and protected in any kind of claim situation. Next is the premium payment. We'll go over the calculation a little bit deeper, but really it's pretty straightforward. Whenever you get your quote, you'll get an account rate, and you take that rate, multiply it by the contract amount, and that's your gross premium. $1 million contract, you have a 2% rate, $1 million times 2%, $20,000. That's how much you have to pay for your bond. Once you pay for your bond, signed, sealed, delivered to your door, the surety bond comes via mail in most cases. Surety bonds are required by the government, so all those working with electronic stuff hasn't really happened with most government obligees yet, but that's definitely something that the NASBP in the surety world is working towards, is getting all the government agencies on board to simplify the issuance of surety bonds electronically. There's definitely some agencies and carriers out there that are all in on this and trying to make this happen for everyone's benefit. So yeah, that concludes this episode.
I am looking forward to the next 2 sessions because I'm going to continue to absorb all of this great information. And with that, I'm going to say ciao for now, everybody. We'll see you on series number 3 in the very, very near future.
Next time.